Hey, so one of the biggest questions we face as business owners is how much do I need to sell to keep my doors open? Now, that's a question that often keeps us up at night, but there's a tool that can help us answer it: the concept of the break even point. This tool is incredibly valuable for understanding our financial health and ensuring the sustainability of our business. So let's start by taking a look by breaking down what the break even point actually is. The break even point is the moment when our total revenue equals our total expenses. At this point, we're not making a profit, but we're not losing money either. It's the minimum amount of sales we need to keep the business running. Think of it as a financial GPS that helps us navigate the tricky terrain of running a business. It shows us where we need to be to cover all our costs and start making a profit. Now, to understand how to calculate the break even point, we need to focus on two main things: fixed costs and contribution margin. Fixed costs are those expenses that stay the same no matter how much we sell. These include things like rent for our business, utility bills, salaries for our staff, insurance, and other regular expenses. These costs are consistent and predictable, which makes them easier to manage, but they also need to be covered by our sales. Now, when I talk about salaries for staff, if you have somebody that's on an hourly schedule, those are wages, and that's going to be in something else, which would be included in the contribution margin. Now, the contribution margin, on the other hand, is the difference between our total sales and our variable costs, like those wages that I was just speaking of. So, variable costs are those that change depending on how much we produce or sell. These include costs for materials, packaging, shipping, and any other expenses that increase the level of production or the number of clients you serve. The contribution margin shows us how much money we have left after covering these variable costs, which can then go towards covering our fixed cost. If either of these components go wrong, if we underestimate our fixed cost or overestimate our contribution margin, our break-even point will be off. This can lead to flawed financial decisions, such as setting unrealistic sales targets or misallocating resources. Now, to make sure our break-even point is accurate and our business strategy is solid, we should also consider something called the margin of safety. Now, the margin of safety measures how much our sales can drop before we start losing money. It's essentially our buffer zone, giving us some breathing room in case of unexpected challenges. A higher margin of safety means we have a bigger cushion against potential downturns, which reduces the risk of falling below our break-even point. Now, if our margin of safety is too low or even negative, it's a clear sign that we need to take action. We should reassess and recalculate our break-even numbers to ensure that our fixed costs and contribution margin are accurately represented. This might involve taking a close look at your expenses, finding ways to reduce cost, or exploring new revenue streams. By getting these numbers straight, we can see our financial situation more clearly and make better decisions. Now, with an accurate break-even point and a strong margin of safety, we can build a resilient business strategy. Knowing where we might be vulnerable helps us to address those areas proactively, reducing risk and keeping our finances stable. This means regularly checking and updating our break-even analysis, especially since business conditions can change quickly. Market shifts, unexpected costs, or changes in customer behavior can all affect our break-even point. Regular check-ins help us stay adaptable and responsive to these changes. Now, in the ongoing challenge of running a business, the break-even point and margin of safety are like our guiding stars. They help us navigate the tricky balance of revenue and expenses, showing us the path to sustainable growth. But remember, these tools are only as good as the data we use. Regular updates, careful assessment, and strategic adjustments are key to making sure our break-even point is reliable. So was this helpful? Please let me know in the comments. And if you have some questions that you'd like to chat with me about, or you want some help in increasing the profit and cash in your business, please make an appointment using the link in the description of this video. Thanks, and have a great rest of your day.